Hello and welcome back to another session of the Retail Traders Special Series. I am Kavita Agrawal, the founder of EXP-Invest. We are here to talk about psychology of market cycles. Why? Because market always unfolds in cycles. We have cycles everywhere and cycles exist at very many different scales of time and very many different levels of prices. We are here to tie up what these market cycles do to our psychology and how that affects our decision making. Because when we know that, we are in a position to make better decisions, and as a result of that, make better trades. Now, this pretty much covers one entire cycle where you can see that the market is bottoming, the market is stopped, the market is rising, and the market is falling. These are the stages of the market. Let's go over it again. The market bottoms, the market comes out of the bottom, the market goes into a rally, the market starts topping out, the market actually tops out, and then the market starts to fall. Right? During each phase of this cycle, we go through our emotional cycle as well. If you don't know how your emotions are unfolding, how will you disallow them from affecting your trading decisions? Let's talk about the market bottom. When it comes to identifying the market cycles, may it be on the intraday time frame, may it be on a positional time frame like a 75-minute hourly or a daily time frame, the intermediate wave as we call it, may it be on the primary trend that's unfolding, that's on the weekly or the monthly time frame. There is one common thing across all time frames, all different cycles. You identify the cycle from the very bottom. So wherever you can find the biggest bottom is where you should identify that as the beginning of the cycle that you're trying to analyze. And when we see very big bottoms on the charts, like for example, the COVID crash, on many different time cycles from minor, intermediate, major to higher and higher, that was actually the cumulative ending of multiple cycles. And that is why it was so sharp. Similar trend was also seen in 2008 when the financial crisis unfolded. Now, when a sharp correction like that happens, we often tend to associate that with an economic event. It's the culmination of multiple cycles coming to an end at the same point of time. Here, what we can see is how the prices increases and how the time is passing. Along with time passing, how is the trend unfolding? When the market is right at the bottom, for example, take the COVID low. One of the reasons why I absolutely wanted to discuss this topic today is that majority of the people in market are those who've joined the market after COVID, which means they've only seen the very rosy part of the market. Why is that bad? Because you don't know how stressful and how terrible it can get when the market starts falling, and how to manage your money, how to manage your risk, how to manage your psyche, because this can really steal your sleep and your peace at night if you don't know how to deal with it. So let's understand what are the emotions that you go through, and we will also talk about how to control those emotions, because I always tell my members that in stock market there is no place for your emotions. We all know about fear and greed. Those are the most popular emotions in the market, but they are not the only ones. There are lots of other emotions. When the market is right at the bottom, every conceivable support was getting breached. You were losing so much money. And for the people who didn't even use a risk management strategy, the rate at which they were seeing their money turn into nothing was unbelievable. And that is where the market bottom begins with the emotion of disbelief. This is the peak of fear. This is when all you want to do is sell everything. This is when people literally jump. It is the saddest point in the market. And this is also where people swear off the stock market a lot of times. The problem with this stage is this is where you need to be optimistic, putting your money in the market. That does not come easily. Look at the trading habit or the trading methodologies of big investors, whom we call the big sharks. They are big buyers when the market is right at the bottom. Hope to some extent starts to come in when the market bottoms out and starts making, say, the first higher high. But there's still a lot of caution in the market and people don't want to yet commit their money. The disbelief and the hope stage, this is the time when you get the best risk to reward ratio on any trade that you might want to pick up. Okay. The next stage is the optimism stage, a massive rally, a strong rally. Optimism starts to set in. Now people start believing that what is unfolding is going to sustain. So by this optimism stage, when it comes to big cats, big money, that already entered the market and is continuing to enter the market. What we call the momentum, the rate of change of price, is the strongest at this point of time, the optimism stage. Then belief stage. Why belief? This is the time when big money gets fully invested. Retail traders start entering the market. Now, because the retail traders or the small players who are small in terms of the money that they put in the market, but they are big in terms of masses, the number of people coming, they start coming in. So this belief stage is when a lot of retail traders start opening new broking account. This thrill stage is where you start seeing a lot of updates in the newspapers, in the magazines. You start seeing targets for 28,000, 30,000 in the market. And then there is euphoria. What does it mean? It means that even somebody who's opened their trading account say 2 months ago are making money to the extent that now they're telling themselves, I can be a full-time trader. I'm going to leave my 9 to 5 job and I'm going to start trading full-time. It seems so easy. I am making money already in the market. How hard can this be? This is euphoria. This is where people make the most number of wrong decisions in the market. When we are going up, it starts with disbelief, it starts with hope, goes to optimism, changes to belief, changes to thrill, and goes on to euphoria. Next comes the complacency stage. We become very complacent even in the belief, thrill, and euphoria stage as well. But this complacency stage has been mentioned here separately because a small dip has happened in the market. Now, an analyst, a person who's experienced in, say, price action analysis or volume analysis, will know that something's changed in the market. This is the stage when you see a massive negative divergence, when you see probably a negative range shift, when you see the volume dipping on the last stage of the rally, and an analyst will know that this is when we need to start booking out our profit. But somebody who's not an analyst or somebody who does not know how to study, say, the economic cycle, so who does not know the concept of even mean reversion, what they're going to think is that this little dip in the market is nothing. This next rally is the best time to get out of the market. So there are two ways to deal with a market top. Either you set a stop loss and you let that get triggered when the first dip happens, which breaks maybe a 200 EMA or a 500 EMA or a previous low. That's the time for you to get out. This is the beginning of a bear market or the beginning of a major correction. So what happens is this complacency stage, instead of taking your money out, you might end up putting more money in. And then you see the market fall further. Now you do not set your stop loss. Firstly, you see your unrealized profits evaporate in the market. Then you see your capital or your P&L turning negative. So earlier it was 1%, 2%, 3% negative where you didn't care. Now it's suddenly 5%, 8%, and 10% negative. Now you want to book your stop loss, but you don't want to book a 10% loss. You're okay booking a 3% loss. And after that, it starts to increase more. It starts going to 12%, 15% loss. Now you're in denial. Now you reach the stage where you're not even looking at your portfolio. And I have seen so many people do this, where the market goes into correction, their bought stocks have gone down 15%, and now they're like, I don't even want to look at my portfolio right now. You know what? I'm just not going to look at it. If I don't look at it, the problem doesn't exist. But that's denial. That's a very psychological thing that is happening to you. And it does not only happen to you, it happens to everybody who participates in the market. Even people who've been seasoned have gone through the same psychological cycle. Post the denial stage comes the panic stage, where you feel like everybody is selling, so I also need to get out. And this is where you're like, you know what? I'm just going to pull the plug. I don't care. I'm not going to talk to anybody. Stock market is not for me. At this stage, you've probably lost 30 to 40% of your capital. This is terrible. Then comes the capitulation stage where you ultimately do pull the plug one fine day and you're like, you know what? I'm just going to take whatever remains, do whatever with it. And then comes anger, because obviously this is also an emotional stage when, say, you get out of a relationship where there is first you get complacent and then you get anxious, deniability, there's panic, and then there's ultimately a lot of anger, followed by, of course, depression. So depression is the stage where the entire economy or the markets have not come out of a major bottom for many, many years at a stretch. This is the stage when people have even lost their retirement money, where people have, imagine the people who took debts in this particular stage. By the time this stage in the market comes, it's time for them to pay back. They don't have money to pay back. How are they going to pay back? They're going to have to dip into their savings, their PFs, their NPS schemes, their retirement funds. All of that is gone at this stage, especially for people who are doing leverage trading. Even if you don't take a loan to do trading, but if you're doing margin trading, if you're doing leverage trading, options and futures, emotional cycle, this psychological cycle is even more intense. So whatever leverage you take, maybe 1x, 2x, 3x, some people trade with 8x leverage, 10x leverage, insane. But whatever leverage you're taking, you can multiply the swing in your own emotional level by that number. If you want to also look at it in a more simplified manner. So the market basically goes through two phases. One is the expansionary phase. One is the contractionary phase. Now, what do you mean by expansion and contraction? We are talking about the supply and demand here. So when the demand is falling. So people are coming to the market to sell shares, but less number of people are coming to the market to buy shares. That is when contraction happens. That is when the prices fall. Naturally, we studied in economics in middle school. When there is supply is high and the demand is low, the prices fall. That is normal. That's also what happens in the market. And this contraction or expansion necessarily does not have to be related with a company's performance. Because even a company that is doing very good business, that is posting good numbers on a trending basis, good revenue growth, good margin expansion, even that company may experience a downward trend because say there is a economic downturn or there is an the industry may be dying industry, but the company on an individual level may be doing good, but it can still experience a downturn. Like for example, take a look at the entire IT industry. When you look at a longer trend, the IT industry is doing well. Now, because the last couple years, the numbers have been slightly subdued, you can see that the prices were correcting. Now the prices have started to rally significantly, even though the earnings are not yet reflecting that kind of positivity. It is possible that in the coming quarters, we see much better results from the IT sector stocks, but the prices have already started to rally. So the contraction and expansion has a lot to do with the supply and demand, or rather the psychology or the sentiments that are circulating. Now, how do you gauge these sentiments in the broad market? So firstly, you need to start with understanding your own psychological metal. Are you an objective person? Are you an emotional person? There is no rule which says that if you're an emotional person, you cannot trade in the market or you cannot be successful. Of course, you can be successful, but you need to work on yourself. If I take my own example, when I started analysis in 2012. I started trading full time in 2019. The biggest revelation for me was that it is a totally different ball game to be a full time trader versus a full time analyst. The intensity of emotions in trading needs active management. And it's one thing to be a good analyst, it's a totally different skill set to be a good trader. And how did I manage my own emotions? I have a whole system for it, which I teach in my advanced technical analysis course. But to give you a brief, I started to first of all plan my trades ahead. Whenever I started analyzing a stock, I went in with a neutral view. So instead of asking the question, should I buy the stock? I started asking the question, what is the chart trying to tell me? You see how there is a change of tone there? One is a leading question. Is it bullish? Should I buy it? One is a neutral question. What is the chart trying to tell me? You leave it on the chart to tell you whether it is bullish or bearish rather than asking yourself, is the chart look bearish? Because if I tell you, can you see a bird there? You might see a bird there even if there is none. But if I ask you, what are you seeing there? You're going to see a bird, you're going to see a cat, you're going to see a man, you're going to see whatever is there. So that objectivity matters a lot. And that objectivity begins in your brain. If you're not thinking objectively, you're not going to do your analysis objectively. You're not going to do your execution objectively. And then you're not going to do your post-trade analysis objectively. So just like in the market cycle, there is a bottom, there is a top, and then there is a bottom again. Similarly, in your trading experience also, there is analysis, there is execution, and again, there is analysis. Because if you're not doing pre-trade and post-trade analysis, you're not going to become a good trader in the market after however amount of time you give. It does not matter. This point of contraction and expansion, right? Within this contraction and expansion also, there are points that you need to identify. So when I am trading, I always trade with the concept of risk-reward ratio, which means that for every unit of risk that I take, I demand a certain amount of reward from the market or for my trade setup. That number is 3, which means that for every single unit of risk, maybe 1%, then the minimum reward should be 3% on my trade setup. If my risk is 2%, then the minimum reward should be 6%. If it is 3%, it should be 9%. So there is this ratio that I always maintain. And I cap my losses per position at 5%. Now, sometimes what happens if I want to say participate in a stock which is very volatile, but the upside is very attractive, then there is also a strategy to allocating the capital in such a way that the average cost reduces. So you allocate your capital in tranches or in installments to reduce the risk. So there are what you need to understand, especially at a psychological level on the market cycle, that there is risk involved in everything from how you're analyzing to how you're creating your positions, to how you're managing your positions, to how you're ultimately exiting your position, and most importantly, what you're doing after you exit your positions. Right? If you don't have a system for every single stage, if you don't have a dashboard dedicated to every single stage, if you're not spending time as required on every single stage, you will not be successful in the long term. Most people spend 80% of the time just buying and selling stocks, whereas you should, in reality, spend barely 10% of your time there. The rest 90% of your time needs to go into identifying good stocks, monitoring your active positions, and trailing your stop losses. These are the 3 stages that need to take the most amount of time. And then, of course, there is past trade analysis. That time is not even included in this entire time management scheme that I've just shared with you. If you wish to connect with me, the best way to do that is by joining my Telegram channel. In this Telegram channel, Trade with Kavita, I share my comment for the market, Nifty and Bank Nifty, every single day, which helps you, gives you direction with respect to what is the expected target, what is the expected support, resistance, all of those things. And every day, I will also share with you hygiene points which you need to make sure that you perform to become a more efficient trader in the market. This is all I had to talk about psychology of a market cycle. Remember, The market always repeats itself. So if we can learn how we behaved in the last cycle, we will know how to behave better in the next cycle. Thank you so much for joining in, and namaste.